Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Samir Narang, Chief Economist at Bank of Baroda, joining in. Welcome to the show, Samir. It's a pleasure to speak to you after a really long time as well. My first question, Samir, coming to you is overall, if you go to see with regards to the kind of impact that we've seen with regards COVID on different economies, no one has been spared. In fact, businesses, again, no one has been spared. Now, if you have to look at the developing economies right now, how do you see the impact versus a developed country?
Actually, if you do compare the developed markets or developed economies with emerging economies, there are a set, so there are, it's a very clear distinction between the emerging markets, as in within the emerging markets and within the advanced economies. So some of the advanced economies, in particularly in Europe, in America being one of the cases, and Japan have been hit very hardly with COVID. They are large economies with larger share of services sector, and the services sector is which has been impacted the most with COVID, as you see is the case in India or Mumbai for that matter. That it's the services economy which is not has not been able to catch up simply because of the social distancing guidelines and availability of public transport and other services. The manufacturing side has done far better in terms of the availability of goods. So, in large developed economies where this share of services is higher, there the hit has been much more harder.
Hmm.
But there are exceptions. One of the exception is, for instance, Germany, which has withstood this slightly better than the other economies. It is also a fact that Germany has been able to manage the COVID situation far better than other economies, and because of which it has been able to withstand the COVID pandemic much better. Its manufacturing sector has responded really well. The production lines are back in force, and they are doing far better than other economies. Now, in the emerging market space, a similar trend is visible. You have some economies, for instance, Taiwan. Their exports this year are higher than last year because
Correct.
because the electronic global electronic demand has gone up. The mobile phone production needs to go up, and they need to produce more and more of
Hmm.
screens, other equipment which is utilized in electronics. Uh, and for that matter, China also is reporting positive data on the export side. India now is reporting positive data for exports for last month. So I think, but there are a number of economies which have not been able to, withstand it to that extent, particularly in Latin America and Sub-Saharan Africa. Zambia, for instance, is on the verge of a pandemic default. So very clear distinction which has appeared, and some economies have been able to withstand it far better than others.
Right. And with this, how do you see, this pandemic impacting the process of deglobalization that was actually underway? Because do you think there's a possibility in the post-pandemic climate we could expect a continued acceleration of deglobalization and unfortunately probably intellectual accommodation of this trend?
That's a very good question, actually. But it's not about the pandemic alone.
Mm,
Actually, we have to step back perhaps 12 years back.
mm,
The deglobalization process started after the 2008 financial crisis. If you see the way global trade was humming at that point in time, and after that, what has happened to global trade, you will see more and more economies have relied on their domestic demand to fuel their growth. A notable example is China, for instance, right, where the share of domestic demand and domestic production is far more than it was earlier. So a number of export-reliant economies have become more and more domestic-oriented economies, and that trend you're absolutely right, will gather an accelerated pace after the pandemic.
Mm,
Because, there were already issues in the global supply chains with respect, particularly with respect to technology and the supply of technology from one geography to the another. And those issues are likely to get aggravated and accelerated. For instance, what we see in terms of the global 5G dominance, which country and which company is going to dominate the 5G market will determine a lot about how the future of global supply chains in the telecom market will move and how the
mm.
technology will see the next phase of evolution. So you're absolutely right. My sense is that you are going to see even further decoupling of global trade as we move into the future.
Right. And do you think, with regards to where the global merchandise export to GDP ratio goes for India, this is the first time that we've seen it declining since the World War II, and then we'd already had COVID, which came in. Where would this actually take us now?
See, if you do look at the overall global trend, last year the global trade was declining, though it was a marginal decline of 2 to 3%. This year, the global trade, both exports and imports combined, in the first half of up to July, the data that is available. For some economies, it's available in August. But if you take that, whatever latest data is available, it's down in double digits by 11 to 12. India is slightly higher right now, but we started catching up in terms of the goods trade. See, if you do look at different parts of the world, you will see very interesting trends which have emerged over the last 30, 40 years.
Mm,
For instance, Germany or Europe has a very high market share in global auto market and chemicals market. So some of the large chemical players in the world, the innovators, are in Germany or in Europe, perhaps France and as well as Germany. The global auto market is dominated by Japan in terms of exports and more importantly, Europe and within that, Germany.
mm,
Telecom market is actually dominated by China. China and Hong Kong combined will have more than 50% share in the global telecom market.
mm, mm,
Is in case of electronics, East Asia and China and Hong Kong, Taiwan, all of these combined have a very, very large share in the global electronic market. So there are different economies or geographies have figured out their core strengths and accordingly innovated and gained dominance in certain markets. So India, for instance, also has to follow the same strategy, figure out certain key areas where we can dominate. For example, in our case, it's the services space where we dominate. We have some large, efficient global companies which are doing really well in time of pandemic as well, as we've seen the results being reported by a few of them. And that is our comparative advantage. And that's where we need to accelerate and gain dominance even more further than anything else. However, that being said, that doesn't mean that India should not aim at domination of the manufacturing space. So, there, I think the reforms that have been undertaken, particularly in terms of labor reforms, to
mm, mm,
clutter those reforms, bring them in simplified codes, four codes instead of earlier perhaps a larger number of laws disaggregated. That will give confidence to enterprises to operate on a larger scale. See, the dominance in services is also driven by scale of a few companies. They were
mm.
small, but they were able to scale it up. So in manufacturing also, if we can engineer those conditions where smaller companies can grow in scale and size, we'll get that dominance. And for that matter, in certain segments, we are doing well. Having said that, textile, we still have a large market share, but two
Mm.
exports, for instance, the large three companies in India have a fairly significant share in two-wheeler exports in some of the African markets. But it's, we have a certain price point where we do well because the Indian market is determined by is price sensitive. At certain price point, we do really well. So if we can deliver the similar products on a global scale at a similar price point with
Mm.
efficiency and quality, we'll get that dominance.
Right. So, do you think we will be able to seize those new export opportunities as major firms are looking to diversify production away from China? However, we have probably a Vietnam, Taiwan, Bangladesh, all of these are there who we really need to compete with as well. Do you think we will be able to increase our market share?
I do believe in certain segments we may be able to get it. For instance, what the government has done in terms of electronics to get to a higher domestic production push in terms of the PLI that has been given. See, it's the starting phase. Once you have the enabling conditions in terms of infrastructure, in terms of skilled labor force, in terms of the supply chain, then is when everything starts coming together. So the until unless you have the entire supply chain integrated with your part of the world, it's very difficult for you to gain from some of these sectors or industries.
Mm.
My sense is that once the government puts in the enabling conditions, I think a critical factor was that there was some degree of subsidy or incentive required for this industry to start. So once it starts, perhaps some of these firms will gain global scale and become dominant and put India on the global manufacturing map. The same is the case with the pharma exports. If you do see the data, pharma exports from India are growing in last month data, if I believe I'm not mistaken, was approximately 24-25% growth. So that was the extent of growth that we are seeing. So if we can scale it up, seize the opportunity, yes, we will get to see some form of manufacturing dominance that will come from India.
Right. And then with this, another important factor that we have to see with regards to revival, Samir, is with how growth pans out from here. The anticipation again is that yes, we will see a negative growth rate in terms of FY21, but how much of inflation are we ready to ignore becomes a point that we need to consider from here on as well. If you talk about where the September month inflation numbers go, yes, it was slightly above what everyone was expecting as well. Do you think that's something which needs to be considered by the government and the RBI, where growth should be a focus and inflation is something which could be sidelined for the time being?
So I think again that's a very good question. But again, I think one should look at the global context here as well, right? Because we are looking at integrating into the global supply chains, so and spurring our manufacturing growth. So I think here what you see is that if you consider the broad emerging market space and developed economies, inflation has come down. For
Mm,
instance, Europe is in deflation, where inflation rate has come down by as much as 1 percentage points from the beginning of the year.
mm,
In America, also inflation has come down. I, in the broader emerging market space, inflation has again come down by whole 1 percentage points between December and the September data that is available. So what you are saying is that there is a massive disinflation or deflation that has happened across the world. Now, India stands as an outlier where inflation has increased. And that is also to do with the supply side bottlenecks that have emerged in the last couple of months. Some of it also to do with the reverse migration of labor. It has to do
mm.
with the higher increase in indirect taxes on petrol and diesel, gold prices going up. So a number of factors which have driven the domestic retail inflation up. Most
Mm.
important, food prices. Within food prices, there have been protein items as well as vegetable prices which have gone up. Some of them are to do with excessive rainfall in certain parts. Some of them are to do with the fact that the supply chains, the absolute amount of supply that is available in the market has come down. So this will get restored, right? This will come back to perhaps not in the immediate future, but if you do look at the next year, the next inflation, as per the RBI's guidance, is somewhere between 4.1 and 4.4. I think our estimates suggest a very similar glide path. We are at around about 4.3% for the next year, financial year. So inflation is likely to come down from here to the next year. There could be some upside risks that may come again, which is one of them is the fact that if there's another wave of COVID that spreads, then that may lead to the next round of supply restrictions in the country, which may keep prices elevated for some more time. That is one. The second is that if there is a large US stimulus or a vaccine available on a global scale, then commodity prices may go up further. And that is to do with the simple fact that the monetary conditions globally are very inflation intensive
Mm.
because the global central banks have expanded their balance sheets. The fiscal deficits are elevated across the world. India,
Correct.
general government fiscal deficit is is going to be in double digits, closer to 12.5 to 13% this year. US is upwards of 15 to 17%. Brazil, every economy we can start naming, and you'll see double-digit fiscal
Mm.
deficits. So these conditions do portray an inflationary picture on the supply side, but a lot depends on the demand side as well. If demand side does pick up because of availability of vaccine, jobs start coming back, and normalcy restores, then of course there can be some inflationary risk. But our baseline assessment is that as of now, inflation is likely to cool off next year from the elevated levels this year.
Right. So with this, what are your growth estimates looking like in terms of GDP if you have to look at FY21 and 22?
So for FY21, we are at negative
Mm.
8.4 thereabouts. So
Mm.
Q4 we expect perhaps is when the economy stabilizes, and next year we are looking at a 9% plus growth as of now in terms of the overall uh, GDP growth expanding, and it would be led to some extent by a large base effect in H1, and growth is likely to pick up to FY22 from the
Right.
next.
And uh, Samir, for this kind of growth to pick up as well, what's the quantum of stimulus according to you, which is further required from here on, wherein the government and the RBI in totality needs to come in?
Right. So again, here, see, we if you look at the global picture and the domestic picture, right, what we do see is the fact that the fiscal deficits, which are going to hit, say, 12.5 or 13% of GDP this year, are likely to remain elevated. So they will come down. There is no question denying that the fiscal deficit will come down, but still, it will be a gradual deacceleration of the deficit
Mm.
situation, which will not be the case only in India, but I reckon a global situation. So one of the learnings that we had after the great financial crisis or the North American banking failure was that the IMF and some of the and ECB for that matter withdrew. The IMF advocated that the fiscal deficit should be reined in quickly, and the ECB followed it up by saying that yes, we are doing it, and they did not give the stimulus to the extent that was required, and that led to an outcome in particularly for Greece and the European area, which led and the fact that the monetary stimulus and the fiscal stimulus in Europe was not up to the mark. So the learnings that we have from that scenario is that perhaps this time when we are emerging out of the pandemic, we may continue with elevated fiscal deficits globally for
Mm.
slightly longer than what we saw from the last crisis. So that is one of the learnings which I think will be implemented in India as well. Hopefully, in India's case, this time the inflation will not resurge or see a surge that we saw in the last cycle when it actually went to double digits and remained
Correct.
close to 8 to 10%. And that is also true with the global energy prices, because global energy prices actually went back up to $100 a barrel, and India's current account deficit started expanding simply because the government spending was elevated at that point in
Mm.
time, right? And the household and the capex cycle lifted off. This time
Mm.
around, the capex cycle may not lift. The private sector capex cycle may not lift off to that extent. So our external account plus the international energy prices may remain in the sweet spot of $40 to $60 a barrel. So that
Mm.
gives us optimism and a feel that yes, perhaps the inflation in India will come off and government can continue with its stimulus for some more time to rebalance the economy.
Right. So what according to you could be the possible, sources of resource that the government needs to look at, in order to increase the stimulus as a percentage of GDP. And there will be some areas where the government might need to come ahead and cut their expenditure as well in this process. So, what could both these areas look like for us?
Correct. I think in this, the policy, the policy initiatives that need to be taken are the ones that the government any which was doing, right? For instance, in terms of asset monetization, is one of the key initiative that the government needs to continue with it. I think they have some uh, decent asset sales lined up, and if we are able to get them and are able to deliver on them, I think we will be able to raise the adequate resources required to kickstart the economy. Uh, and it is an example which has been seen in many other countries in the past history. For instance, be it Singapore, be it the United Kingdom, be it Indonesia, there are many countries which have been able to monetize their assets historically in the past, let them be run by private sector participation or through a more efficient management system, which leads to better returns, more productivity, and thus more growth in the longer run. And the government has the ability to get resources out of those asset sales and invest them back in the economy to generate more productivity.
Right. And how important would fiscal monetization be at this hour? And do you think this could be the right time for the government to look at fiscal monetization?
See, I think the current year, for instance, when you look at it, what we see is that the government's extended or expanded the deficits have been financed quite well. For the state governments as well, the RBI now has introduced an open market purchase scheme, which RBI never used to buy state government bonds. Now it's saying that it's open to buying them as well to balance that market. So, to that extent, if the banking sector has emerged as the largest buyer of government bonds, the central government bonds and state government bonds, simply because a large inflow of deposits or resources which has or savings of households and corporates have been going into the banking sector, which has been deployed for into the both the state government as well as the central government security. Simply because there is lack of demand for credit from the private sector and the household sector. So the extra inflow of resources have been deployed in the government securities market. My sense is that this situation of extra surplus savings is seen globally and it may continue in India also for some time. Till such time we have a normalization of consumer behavior in terms of spending, in terms of going out, going to the restaurants, seeing those weddings again where people do spend a lot of their income. So until back to that kind of normalization, the savings rate perhaps may remain slightly on the higher side, which will in itself uh, uh, generate the resources to ensure that the deficits are financed through the bonds, which the government is likely to issue to raise resources. So I think that market has balanced itself out well, and RBI has clearly indicated that it is there as the lender of the last resort or the buyer of government security in the market to balance the market. I think this RBI statement and the governor's statement was very clear, very eloquent in a way that the expectations from both from the traders as well as the banking sector in terms of the trading book should be in line with what the RBI is thinking.
Right. And very interestingly, the RBI has really acted well in the last couple of months with regards to where infusing liquidity in the system goes. However, one thing has been that the credit growth has not really picked up in spite of the quantum of rate cuts that we've already seen so far. The last policy meet also, Samir, the RBI has maintained an accommodative stance. Now, taking the September inflation print into consideration, do you think there is a possibility where, it could have any implications on the RBI's policy going forward, say in terms of the interest rate dynamics? Do you think that could change? And secondly, do you think there is a proper, clear strategy that the RBI still needs to develop as to what needs to be done from here on? Because credit growth is something which yet needs to pick up.
No, you're absolutely right. But the credit growth not picking up is essentially a function of demand, right? So the GDP growth came down by 24% YOY. This quarter also we are going to see a negative print, and even Q3 we're going to continue to see negative print. If you see a slightly long-term trend, what you see is the overall growth of credit, the nominal growth of credit, is in line with the nominal GDP growth. So that ratio for the banking sector between 2010 and 20 has been pretty much flat at 51 odd percent. There's not much of a change there because, and it's intellectually or in terms of theoretically also it makes sense that whatever is the increase in demand the from GDP is also the increase in credit in terms of nominal demand, nominal growth of GDP, and nominal demand for credit is pretty much in sync, and that is how it should be. Unless and until you have a large investment cycle which fuels demand for credit. That is what happened in the last cycle between, say, 2004 and 2007, and then between 2009 and 12, when we have a small capex cycle. That is when we saw the credit GDP ratio going up because there is demand from investment side, which is not the case for the last few years now. So pretty much that moves in line. So if you do expect the nominal GDP of the country going down by 5%, adjusted for the GDP deflator and the real GDP, then even a 5% credit growth is not all that bad. And that has been possible simply because the government has given certain key credit schemes. For instance, the credit scheme for MSMEs will definitely lead to an increase in demand for credit or a supply of credit to that sector. So, and agri sector continues to doing well in terms of overall growth. So there are certain segments which are where there is a demand for credit, or because of government intervention, there is a demand for credit which has been generated. But apart from that, if you look at the large corporate space or the investment credit space, there is hardly any demand for credit, and that is symptomatic of the overall credit demand. So there's nothing much that even the RBI can do over there.
Right. And then with this, another aspect with the banking space right now is that, they've given enough moratoriums with regards to stressed assets. They've looked at the loan recast scheme as well. But do you think all of this is going to be enough? Or do you think this is something which is actually going to put a lot of strain on the financial sector as a whole, where resolving the NPAs is going to be a major challenge, for which now the urgency of a bad bank really becomes imminent?
See, if you look at let's take a step back here, right? And let's look at how has the credit growth evolved in the last 4 or 5 years, or perhaps 10 years. So you'll see that the incremental demand for corporate credit has been fairly weak, right? A number of corporate entities have gone through a bankruptcy process, and the new buyers or the new owners are far more resilient and far have much deeper pockets to see through a pandemic. And that was the essential reason for undergoing a bankruptcy process and a change in management, that you have owners which can see through a cycle. So that was the essential reason why we went through that cycle and process. So my contention over there is that some of the large corporate entities perhaps may be in a reasonable position to weather the pandemic. Now, the other part of the economy or the credit growth which has done really well is the retail. So in comparison with a very, very weak demand for corporate credit, retail demand for credit has been fairly buoyant. Some of it is also been buoyant because for the banking sector, because NBFCs have withdrawn from that space to some extent in the last 2 to 3 years after the default that has happened in uh, one NBFC and one HFC, right? So what we have seen is that the retail credit space has done relatively better, and corporate demand has been weak. So yes, given the pandemic, there will be some stress that will come both in corporate credit as well as retail, because retail has grown. So that is where I think incremental stress may come more than it may come for corporate credit. Within corporate credit, the stress is likely to come in a few sectors which have been impacted by the pandemic the most, which are to do with which where social distancing cannot be avoided, perhaps hotels, restaurants, airlines, all those sectors, which will require some level of forbearance, and they require a helping hand to go through and see through the crisis. So a 2 year or whatever moratorium then the banks decide once these sectors go through a round of restructuring. That is fair, and that will help them to get out of the restructuring get out of the restructuring window in a time bound manner and come back to normalcy. There are certain businesses which go through their own mortality because of change in technology and other issues that may accelerate because of the pandemic for a year or two. But I think that will normalize. So my sense is yes, there will be some stress which will come in retail space because growth has been fairly buoyant. There have been job losses. There have been salary cuts. Particularly, there has been an impact, as we've seen globally as well as in India, for certain jobs which are at the lower end, which cannot work without distancing. For instance, in a restaurant business or some other businesses which in services sector which require intensive customer contact. There, wherever consumer credit has been taken out, there will be a requirement of restructuring before jobs come back. So that is pretty much how it will play out. But having said that, it may not be fair to compare it with the last cycle, because in the last cycle we were seeing 20% capex growth in certain key sectors. So if you do see, the corporate credit growth was running at 20% between 2009 and 2013. And we saw an incremental stress that came largely from that space. This time around, for the last 5 years, we've hardly seen any corporate credit growth. It's mostly been retail, and I think my sense is that given the impact of the pandemic, perhaps more stress may come from retail rather than corporate. Within corporate, it will be focused in certain sectors like which will require restructuring, perhaps commercial real estate and retail space, and some of those developers may require restructuring.
Well, absolutely. And the RBI conducted a stress test as well, and they're estimating the gross NPA to rise in the range of almost around, say, 12.5 to around 15 odd percent on the back of COVID. And a lot of analysts are probably expecting it to climb even higher. But with this, now, if you have to look at the private banks as well as the PSUs, what's happened is the private banks have been the first ones to react and have started to raise capital to protect their balance sheet. Whereas I was reading one of the reports which was indicating that little over 2.1 lakh crores is what the public sector banks will need with regards to external capital over the next 2 years to tackle the capital shortages on the back of this impact. Now, taking this into consideration, what's the message that the system is giving us? The private banks have already started raising capital. Do you think now the government, the RBI, needs to step up with regards to PSU divestments as well to go ahead and match up?
No, I know that point is very valid, and it's a very good point. See, the private sector banks have already raised capital. Their tier ones are running, I think, above 15% now, so they are very well capitalized. The PSUs, the public sector banks, have the backing of the government, and the government has already indicated that it will provide capital as the need may be. I think for now, to understand the trajectory, how it will play out, first of all, we need to understand what is the hit or overall impact of the pandemic on the bank balance sheets, particularly the state-owned banks, number one. Number two, we also need to understand how much of corporate restructuring will come in this phase, which we'll know only in Q probably by December, and implementation and all of that will happen in Q4, right? So I think it is too early right now. So in terms of projections, of course, there will be many projections that will be coming, but actually how the banking system, particularly state-owned banks, will play out, that will only be known perhaps by March of this year. So that is when we will have a clear understanding and assessment of how much of capital is required and in what phases perhaps the government will also inject. So my sense is that perhaps around the budget, we'll have a much better understanding from the government as well, how they are looking at it. And to be fair, it's too early to comment on a number right now. And yes, well, there are certain projections, and it's fair. But I think in terms of government's resolve, last time also when they saw a requirement, they did inject a reasonable amount of capital. And that came with their own series of reforms, particularly in terms of ensuring that you have large universal banks which can withstand the cycle. Unfortunately, the slowdown or because of the pandemic happened just when the mergers were done. Perhaps if some few years of curation would have been given to them, I think they would have been in a position to withstand the shock in itself, because the entire rationale for making larger banks was that they will have enough operating profit to withstand an economic shock. I think that that underlying rationale will play out. It's a matter of time, because size does matter, in particularly in banking. You may not. I mean, in terms of data points. If you see any big geography, be it China, be it Japan, you look at America, Germany, UK, the size of the top 4 or 5 banks in terms of market share has only gone up in the last 10 or 15 or 20 years. And it's unbelievable data, the kind of market concentration for the large banks that has happened globally. I think with this, the government has been able to engineer a similar thing for India, particularly for the banks owned by the government. They will be in a position to invest, they'll be in a position to organically grow. And I think all data suggests globally that there is a step in the right direction. Unfortunately, the pandemic has happened before that could have played out in terms of numbers. So I think in terms of actual requirement, we'll only get to know perhaps closer to the budget, and so we should wait for that. But structurally, I think the banks are stronger for the next 5 years than they would have been otherwise.
Right. So overall, Samir, very lastly, I mean, I know no one's able to really ascertain as such as to when do we see normalcy back from a healthcare perspective, from an economic perspective. However, if you have to take the economic perspective into consideration, what's your anticipation? Like, when do you think India as a country could come back to normalcy?
So I think the bigger issue is that you have a 7 billion population,
Correct.
and you require probably 1 or 2 doses. Some people do suggest perhaps you require a booster shot as well. So we don't know how it will play out, and I'm not a healthcare expert or an epidemiologist, but whatever little understanding we have, perhaps if you require 2 doses, right, over a period of time, then the supply side also has to catch up, which will take some time. So, and if you do believe some of the global experts or health experts, they reckon that a vaccine perhaps will be on the table by December or perhaps January or February. So, my sense is that it may take another 6 to 9 months for it to be administered on a large scale across the world. And India perhaps will be slightly better off. The reason I say that is that you already have a supply chain for vaccination in India.
Right.
If you consider a number, India and some of the Asian countries do stand out for running mass immunization or mass vaccine programs for most of their population, or kids at least, right? For be it polio or some other vaccines that we do administer to kids. So we have a robust mechanism which is already in place, which may not be actually in place in other countries which do not do such vaccination programs. So if I do compare India to others, we perhaps because of our earlier experiences, we may administer it and implement it a bit faster than other countries. But again, the absolute amount of doses that is required will be a bottleneck for some time. So my sense is that perhaps next calendar year is when, towards the maybe H2 of next year, H2 of financial year next year is when you may see that we are emerging out of the health crisis completely, and we get back to a normal level of economic and consumer behavior as well as psychology.
Right. And that's something that all of us will actually wait out for, as well as to when normalcy comes back. But thank you, Samir, so much for joining us on the show. It was a pleasure to speak to you as well. I hope you just enjoyed the discussion as well. We should see you back soon again, and stay safe.
Thank you so much. I enjoyed it a lot. And have a great day, and be healthy and be safe. Thank you.
Wish you the same as well.